we shall be looking into some of the salient tax provisions in the proposed Finance Bill 2022 and the potential tax implications on businesses for both indigenous and non-resident companies. As you may be aware, over the past 3 years, the Finance Act has become an eagerly anticipated annual ritual among tax practitioners and taxpayers because its changes usually come with attendant implications and an outlook for businesses to reevaluate their strategies in order to mitigate tax exposure. One of the changes in the proposed Finance Bill 2022 is an increase in the tertiary education tax rate. It will be recalled that the Finance Act 2021 increased the TET rate from 2% to 2.5%. Now, the Finance Bill 2022 proposes to increase the TET rate from 2.5% to 3% effective January 2023. Although the government may perceive this as an avenue to increase tax revenue, well, it is noteworthy that the increase in the TET rate is not in order with one of the implementation strategies of national tax policy to reduce income tax rates and tilt towards indirect taxes, in order to most especially, as they said, increase investment and encourage job creation. The Finance Bill 2022 also proposes the inclusion of digital assets as chargeable assets for the purpose of capital gains tax (CGT). Although it did not clearly state what constitutes digital assets, some of the digital assets might of course include cryptocurrency and non-fungible tokens (NFTs). Meanwhile, considering the intangible nature of digital assets, the determination of the historical value of a digital asset may become a concern where such digital assets are proprietary and internally developed. Another proposed amendment in the Finance Bill 2022 is in computing chargeable gains. Prior to the bill, capital losses were not deductible against proceeds from disposal of chargeable assets. The Finance Bill 2022 now looks to allow taxpayers net of losses which accrue on disposal of any assets from gains accruing to the person disposing the assets if they are within the same asset class. With this, we advise taxpayers to group disposal of qualifying assets on an asset-by-asset basis and aggregate the net change from each asset class. The Finance Bill 2022 also proposes the appointment of value-added tax collection agents. As you may be aware, Section 14 of the VAT Act empowers the tax authority to appoint any person as a VAT collection agent, which is already evident in VAT operation in the oil and gas industries, as well as government parastatals, and even recently in banks and telecom companies, which have been appointed as collection agents of VAT. Meanwhile, the timeline of rendering VAT returns from such collection agents, according to the Finance Bill 2022, is the 14th of the subsequent month. Also, the Finance Bill 2022 proposes an expansion of the scope of services liable to excise duties, including but not limited to telecommunication services. It further imposes a levy of 0.5% on goods imported into Nigeria from outside Africa to finance capital contributions and other financial obligations to multilateral institutions like the United Nations. Well, we expect this to enable more revenue generation and capture more taxpayers into the tax net, thereby serving as an additional cost of doing business in Nigeria. Conclusively, it is crystal clear that the recent budget deficit and the low revenue on the part of the government has forced the government to aggressively drive tax revenue. Meanwhile, it is expedient that the government does not push aggressive revenue by making initiatives that will overburden taxpayers. Hopefully, more tax benefits and incentives will be granted to taxpayers in order to stimulate business activities and encourage more investments. To read more on our articles, please visit our website and subscribe using the button below. Thank you.